Hi folks, Hedley Widdop here from Lion Selection Group, running through a recap of the Lion Selection Group overview that was given at Lion's AGM in Melbourne on the 7th of December. There's a separate presentation file which is available that covers the market overview given at the same time. You should be able to find that at the same place as you found this recording and slides. So please do. Standard disclaimer slide. Please have a careful read of that one in your own time when you get a chance. A snapshot of Lion. We've been around for 25 years. Lion is ASX listed. It invests in the junior resources space, which means that it tracks the explorers and the developers, which are the really high growth end of the mining industry. We've been doing that now for 25 years, have a track record of value creation and dividend distribution. And as it stands, we have both a portfolio and a very strong balance sheet. So there's exposure to gold, copper, nickel, phosphate primarily, but the main asset we have, and this is going to grow, is cash. During 2023, the NTA is going to become predominantly cash. I'm going to run through that in just a second. And against the backdrop, which I'll present in a little bit more detail in the market overview, Lion is extremely strongly positioned to invest in a weakening market. Snapshot of the net tangible asset backing of Lion, and I'm starting this part of the story in July 2021. I picked that date primarily because that was the last NTA we announced before we started the divestment process of our Indonesian assets, which took place between 2021 and early 2022. So in 2021, Lion's NTA was about 85% exposure to pre-development Indonesian gold assets. Wonderful gold assets, but located in Indonesia, which is a difficult place to do business. Small remaining portfolio on top of that, and an even smaller amount of cash. Fast forward to November 2022, which was the last NTA we published before the AGM took place. Lion's investment in Nusantara was sold. It had been sold into the takeover by Indika, and Lion's joint venture interest in Pani had also been sold to Merdeka and some of its shareholders. And that transaction took place. It's due to settle in January-February next year. And in the time since, we've seen NTA growth, and the jump from 62.6 to 63.6 isn't a great one, but that excludes the payment of 5 cents per share of dividend in that time as well. There was 3.5 cents paid in April and 1.5 cents paid more recently in October. What remains in Lion's portfolio, the other hasn't changed much, but the cash portion at that point has grown remarkably. And there's a large part of the portfolio, or the NTA I should say, which is the remaining Pani Exit Consideration, which is going to be settled very, very soon. And if we look at what that is going to look like, we'll receive $30 million at least, US $30 million, for the sale of some Merdeka shares and deferred cash. So all of that portion will become cash by February 2023. I can't tell you what the NTA is going to be at that point in cents per share, but that's a breakdown of what we think the portfolio is going to look like in terms of cash versus investments at that point in time. So Lion will be a very strongly cashed investor in the market at that point. During this year, Lion has re-established the payment of dividends, and I wanted to provide a snapshot of what dividend payments have looked like over the history of Lion, just as a bit of a backdrop to what's happened with the recent payment of those. So through, I would say, the first couple of decades of Lion's life, Lion had paid a very reasonable amount of dividends to shareholders over time, as well as a distribution of a share in a company called Catalpa, which is now called Evolution Mining. So if you'd been a shareholder in Lion right along the way there, you would have taken out well over $2 worth of dividends and distributions up to the point where Lion was demerged into Lion and the Gold Co, which was spun out of Lion, which was a large holding in Catalpa. Lion was subsequently listed on the National Stock Exchange and had distributed a huge amount of value by distributing Catalpa and a large off-market buyback, which took place at the same time. What that meant was that Lion didn't have a great deal of funding available to it for investment through the soft part of the cycle in 2009, and then again when the market started to crash in 2011 and 12 and the downturn which took us through to 2015. What Lion was exposed to and built a larger and larger exposure to was two very good gold assets in Indonesia. Having held those, we're unable to invest in many new things, but having sold them, we were then able to pay dividends. And the payment of the 3.5 and then 1.5 cent dividends marks the recommencement of dividend payment through Lion. And we've been very, very clear in the disclosures to date about what Lion's dividend policy is, and that is the aim to pay sustainable dividends from surplus investment proceeds, and balancing that with the investment needs of the company, with market conditions and capital growth both kept firmly in mind. I just wanted to recap the Pani exit, and this is a little while ago. Now it was announced at the end of January in 2022. The headline number was an exit value of at least $52 million US. I'm going to break that down in a minute to explain what I mean by at least. At the time, that was 17% above Lion's NTA, so it was an accretive exit for us. It was a 3.5 times return on investment, so it was also a very profitable exit for Lion on selling out of Pani. And it was done at a logical point of the asset cycle prior to what would have been significant expenditure. Just to tell you exactly what that means, I've got an aerial photo of Pani on the right-hand side here, so you can see the scarring from artisanal mining, which is over most of a hill. In the middle of that dotted box, which was the outline of Lion's license, it's a very large hill. I don't know if you'd call it a mountain, but certainly very large. And that's had artisanal mining on it for over 30 years. So there's a lot of gold in the area, and that extends through the district, as you can see it going off the license. In 2013, a resource of about 2.4 million ounces was defined on the license that Lion was involved in. And not long after that, the neighbour, which turned out to be not such a great neighbour, defined a resource of their own abutting the boundary of the license that Lion was involved in. Now, geologically speaking, those two resources are one and the same. They're connected, and there is mineralisation which extends from one to the other. Hence the attraction of this asset. But in selling out, Lion was able to do so at a point before it had to commit substantial investment to the asset, and a partner, former partner, I should say, Medeka, who is now the manager and progressing this asset, has engaged in a US $150 million feasibility study to take this project through to the point where it can be developed. Lion's interest in that $150 million feasibility would have been $50 million worth of expenditure, which Lion would have had to find and then deploy. So the exit was very, very attractive, not only in terms of the value which we could take out, but in terms of the expenditure that we could avoid. And then, of course, turning that into cash, it's provided for Lion to recommence dividend payments, which I've just talked to, and more excitingly, to return to investing at quite an interesting time in the market. To break down the Pani consideration a little bit further, so I've said at least $52 million US received for that. The first part of the payment was $22 million US of cash. That was banked. It was turned into Aussie dollars in February 2022, so that one's said and done. And what remains is a $10 million deferred cash payment, and for us to cash in $20 million worth of Medeka stock. To track the value of those things in time, I've put together a chart from the end of January 22 through till now, which just shows how the value of these have changed. And the reason why I need to show you how they've changed is because the value of the Medeka stock influences the value of a potential cash top-up and the value of the $10 million deferred cash payment. And just to separate those a bit more, I'll pull them apart. You can see the periods. There's been three main periods where the value of the Medeka stock had fallen below a $20 million threshold. And under such circumstances, we'd be entitled to a cash payment, which would bring us back up to the $20 million worth of for that Medeka stock. Under those circumstances, there's a full value of a $10 million cash payment, which would also be made at the point where this can all be crystallised. Now, it doesn't come together until the end of January 2023, which is why we've held the stock to this point, because if we were to sell it, we could be selling out before the full value of the shares could be recognised and capture some upside. But additionally, if Medeka were to strongly perform in that period, the value of the deferred cash payment would be determined at the end of January 2023, in which case we could be leaving some cash on the table. So there's a process to run through early next year, which will bring all of that to bear and turn it into cash. And I guess by the time you get get to the end of that, what you really need to take away from this slide is that we'll sell the Medeka stock in early 2023. We'll receive the deferred cash. The two will be calculated together, and we will take at least $30 million US out of that. So we think of this as cash. It's worth $30 million US, no less, possibly a little bit more. Turning to Lion's remaining portfolio, so this is the small quadrant of the donut that I was showing you earlier. The most significant investment after Medeka and the deferred settlement is PhosCo. PhosCo is Australian listed, PHO is the code, and it's focused on Tunisia and a rock phosphate project there. Now, there's been a bit of a checkered history of this. The company used to be called Selamin and went through a process of having to recover its ownership of the asset that it has in Tunisia after its partner had stolen the company shares, which removed its exposure altogether. The ownership of those shares has been not only restored, but there are damages still owed to PhosCo, and PhosCo is going through the process of moving towards being able to push that asset through feasibility and whatever comes after that. Scoping study has just been returned, and that shows an extremely compelling value proposition for PhosCo at Jacetma. And it's a world-class scale rock phosphate project with nigh on 150 million tonnes at over 20% rock phosphate, P2O5 in the ground. That's a very significant resource, not only on the global scale, but particularly with respect to what's happened in the phosphate market with the conflict in Russia and Ukraine, which had both been significant providers of phosphate to the world market until what happened. Now, PhosCo's experience in Tunisia certainly puts a bit of a black mark on the country, but I think it's important to break down whether this is a partner issue, a country issue, or both. And I think what we've been able to discern from Lion's experience, certainly globally, is that these things can happen anywhere in the world, that a crooked partner can get the better of a company which is not watching carefully enough, particularly if there's a bit of sloppiness involved. But furthermore, Tunisia has seen banking of large-scale projects as well as the investment of globally significant projects, mostly in the hydrocarbon industry. But nevertheless, that's a very, very similar form of investment as would be contemplated for a phosphate project in this part of the world. So we see this as a country which is very much able to be done business in, and on the full return and crystallisation of the Jacetma ownership, then that one can go forward strongly. Not waiting for that to happen, PhosCo has also been very active in business development in the same space inside Tunisia, and has pegged 100% ownership with no partner involved, a fresh project. Now, it's at an earlier stage, but it presents a very large-scale target with outcropping phosphate, which has been mapped on that prospect already at Sakana. Sakana is only 10 kilometres from Jacetma. It's a very, very similar in terms of topography and infrastructure setup. So all of the assumptions which were made for the scoping study for Jacetma can be superimposed on the future of Sakana. And it's come, I guess you would say, just the exploration process to understand exactly what potential is available there. The mapping which has been done has indicated that there could be quite a considerable amount there. The thicknesses and the depths aren't quite known yet, but because this is exposed as a mesa, which is a hill that sticks out of the ground with a flat top, it's been able to be walked around. And there are grades of phosphate on the edges of that between just below 20 and well over 20% P2O5. So the potential to contain very attractive grades as well. So the future, I think, is bright for PhosCo, and that's one which Lion is tracking very carefully. Second most significant asset in the portfolio, also a long-held investment of Lion's, is Erdene. This is gold in Mongolia. It's TSX listed. We're represented on the board there. This is a fabulous small gold project which is shovel ready. It's got permits and bankable feasibility study in place. But having gone through the permit process, that's enabled some time to continue to explore the area. And Erdene's been extremely successful in discovering a number of brand new gold occurrences which have been returning not only high grade, but also quite thick accumulations of gold of a very, very similar style to what they'd found at Bayankundi in 2015, which is now ready to mine. So rather than looking like a small gold development prospect, this now looks like Erdene has scratched the surface of a major new epithermal gold district in southern Mongolia, and has the permits in place to be able to start mining, but I think the prospects of this getting bigger and much longer term are fantastic. So we're watching for that to unfold in the near future. The most recent investment which Lion has made, and this was announced shortly before the AGM, is in an unlisted company called Plutonic. Lion has made $1 million investment, and this was off a very, very low enterprise value for Plutonic. It's an early stage company, which is a little bit rare for Lion to take an interest in, but this is, I think you would say, a quite unique circumstance. And the uniqueness of this is that we're not just looking for a project to be discovered in this part of the world. If there's a discovery made, it will be a district that's put on the map, and there'll be a pegging rush around it. What we're looking for is something very, very significant there, with some people who've been have a strong track record of originating new and early stage investment prospects. So Champion, which sits almost in the middle of Australia, sits within a major structural corridor which underpins the continent, very long lived, and has seen a lot of fluids move up through it. Australia is cross-cut by several of these, and in the 70s, I think it was significant work that was done by WMC, and when exploring at the intersections of some of these crustal scale lineaments, and that work culminated in the discovery of Olympic Dam, which is a very significant discovery at the intersection of crustal scale lineaments. So here we have a target which sits within that sort of a corridor, and it sits very close to the edge of the old part of continental Australia at the interface of the more recently accreted Eastern Australia. So it's been a structurally active part of the world and has probably seen very, very significant fluid flow at the same time as deposits were being emplaced in Eastern Australia, the likes of Cadia, which is operated by Newcrest near Orange in New South Wales, and things like the Victorian goldfields, which of course have been prolific producers of gold. It's very, very early stage, and all we have to go on for the prospectivity of this, other than that tectonic model, is enormous quartz accumulations which sit in this very, very small part, or I should say 4,500 square kilometres. So it's not a small area in terms of the size of the footprint, but it is quite small in terms of just how discreetly these quartz veins have been deposited. And the textures and the very, very few samples which have been taken are extremely encouraging for what might indicate that there is high prospectivity there for new goldfields to be discovered. So Lion's invested $1 million. Plutonic is going to raise a small amount alongside that, which will fund early stage work and hopefully take them through until an IPO in 2024 or beyond. So tremendously exciting exploration play under Lion's belt there, and an unlisted company, so it's a real point of difference there. As I said, what we're looking for is it's a district play. We're not looking for one project here. It's to discover a district, which could be quite significant. Lion's portfolio, if you put it together and try to illustrate just how mature some of these investments are, I've shown it alongside a fairly typical resource project pyramid, which is how a lot of mining companies do it. At the top, we've got our exposure to Medeka. It's a operating company. Erdene and PhosCo, which are the largest legacy investments there, are quite advanced with studies in place. Casbar, quite a small investment in terms of the value that it sits within the NTA, also quite advanced with a study. And then we've got the more recent investments, Great Boulder, which was done earlier in 2022, Plutonic, which has just been announced, and Kinjin, which is quite a small investment in a seed stage company. Fantastic epithermal gold play, creating a land bank in Japan of some very, very exciting prospects, some of which have been previously mined of high-grade gold. We haven't discussed that great deal in our disclosures because it's such a small part of the value, but could jump to something significant in the future. Lion, though, is a little bit unusual, and certainly not like most other mining companies, in that pyramid doesn't necessarily fit the description of how we would like to allocate our funding. Mining companies typically have a lot of early stage things and far fewer operations. Lion, on the other hand, and we'll just wait for this to around, would like to allocate its investment in a way which is a little bit more proportional to the areas that we see the greatest chance for value uplift. We've talked a lot in the past about the value curve, and you can see that on the right-hand side, and I'm just going to flip that around to fit the sequence that we see on the left. So we're just turning that on its edge. Lion's portfolio, I think we would see it developing with the most investment in the resource definition and then the feasibility study stages, when the opportunity to enter at a lower value, knowing that there is uplift to follow, is going to be the most significant. At the moment, Lion doesn't feel it needs to be all that aggressive. We describe ourselves as a cautious investor whilst the market's weakening. We've got a balance sheet which provides huge optionality on the kinds of juniors which we can invest in, particularly if they're to become cheaper. And the target portfolio that we want to put together over the next year or year and a half or 2 years, we hope to include a diverse mixture of commodities. That'll be between precious metals, base metals, and the strategic or base or battery materials. Very strong Australia focus in the new investments, and targeted to the project stages that occur just before the value uplifts in that development curve that we've shown in between the development, feasibility, resource definition, early stage spread on the left. And that's to be built up, we think, very strongly during a weakening market. I think to sum all of that up, we're watching at the moment. We see tremendous opportunities in the market to be investing, but we also see huge volatility. Whilst there's volatility in large cap stocks, what that has caused in the past has been a lack of liquidity in the smaller stocks. So micro caps cop it in the neck when there's volatility in any part of the market, and the explorers, which is where Lion looks, have always suffered whenever there's weakness in the market. If you take away liquidity, they can't fund themselves and share prices tend to suffer. We're watching that happen right now. So Lion is tremendously well positioned to take advantage of these lucrative things which come along when companies that depend on market funding see that funding taken away. There's not so much that we can say about the new investment opportunities that we've assessed, because we'd be saying a lot of things about companies which we don't have any exposure to. And it frustrates me a great deal that there's no real good way for us to describe just how many companies we've looked at in the 10 months or so since we announced the sale of Pani. It's been a great deal. We've gone on a lot of field trips and we've run detailed assessments over a number of things. We've come away with a very, very strong watch list of companies which we would like to invest in. And in most cases, the issue that we've had is that we can see they need to raise money. We can see that the market is weakening. And we think that the value which we're having to, or the price at least, at which we're having to invest is likely to be lower in the future. So in most cases, we've chosen to hold off. There's one or two things that you really can't wait for, and Plutonic was one of those. It doesn't come along very often, and when it does, particularly if it's cheap, it's a fantastic thing to get involved with. So we can be opportunistic, but we feel that the deployment of Lion's funding over the next year, year and a half is probably going to accelerate after a period of watching those things and seeing the juniors become weaker. Some examples here, I think, from 4 states of field trips that we've been on, and expect to add to that as the time goes on. I'll wrap up the presentation on Lion with the Lion clock. The AGM, Robin started his chairman's address standing in for Barry Sullivan, who wasn't able to make the meeting, by showing the Lion clock, allowing it to chime 12 times and then showing the time change. So as a quick recap of the thunder that he stole, we've seen the progression of the cycle from the boom starting in 2016 right through to a very hot market in 2021. We've seen liquidity rise to what was probably a record level in 2021, and 2022 hasn't seen nearly the same amount of liquidity. And in the broader market at the same time, we've seen extreme volatility. Up until recently, we'd had the top region of the clock where the crash starts to happen between, say, 11:30 and 12:30 shaded. And had a lot of people say, well, can you make a conviction call on it? What time do you really think it is? We're quite prepared now to say that the time is just past 12. So that hand shows about 5 past 12 on the Lion clock. And this is the time when junior resources stocks are most vulnerable. They encounter funding challenges, and that will lead to equity price weakness. Even if there's not a tremendous amount of equity price weakness across the equity market, the juniors are the one who will suffer the most. So conclusions, I think we'll use these same ones for the market presentation if you watch that. The equity market has had a tech-led weakness. Tech stocks have copped it the hardest if you look at sector by sector. Mine have been reasonably resilient, and the junior miners, well, they've started to soften, but so far all we've seen is that liquidity has been removed. We haven't really seen the impingement on share prices across the board for the explorers and developers just yet, but we expect that to happen. 2023 will be a major test of liquidity in the market, and if there's going to be rubber hitting the road of junior resources stocks weakening, we expect that'll be the time when it takes place, because they'll come out of Christmas, particularly in Australia, waiting for the market to open in February, and we may see a rush of those companies coming to raise money at that time. Liquidity, now is a great time to have cash, and it's a great time to be watching for those opportunities to come to us, which is exactly what Lion is doing and anticipating doing in 2023. It's going to be an exciting year for us on that basis. Mining long term, particularly if you can look beyond the horizon of the impingement of inflation and the current market weakness, has a very bright future. Commodities in most cases have demand outlooks which far exceed the ability to supply. So commodity prices should be strong. But what the world economy needs to work through first is probably going to provide some weakness in that space. So we need to wait for that to wash through before we can say that we're in the next commodity price cycle. Thank you all for your support or your interest. Please do hit up the Lion website and subscribe for our announcements. Keep in touch. If anyone has any questions, you can also hit us up via the website inquiry line there, and look forward to hearing from you. Thank you to shareholders and others for their inquiries along the way. We look forward to 2023 and wish you all a safe and prosperous holiday season.